Hello, everybody. I'm Tom Dorsey, and I'm lucky to have a friend of mine with me here, Jeff Chang from CBOE Vest. They do some unique things, and I want to talk to you a moment about an idea that he gave me that was so important. It's not often that you get someone who gives you some information, an idea that really sticks to you and makes a difference. I've told this 100 times to other people, but I want to start off with the concept of bagging apples, because eventually we're going to get back into that for the advisor and how you can better serve your customer. We were at a cigar lounge, and I would text you, and I'd say, "What are you doing?" You'd say, "I'm bagging apples." And you wouldn't say anything about what you were doing, until you got down there and explained to me what you meant by bagging apples. And it was like that light bulb that went off in my mind. And I want you to tell that story.
Sure. First off, thanks, Tom, for having me. The story really comes from Richard Thaler, who won the Nobel Prize in Economics in 2017, which part of that was they had a study there about elementary school kids and apples, where they would essentially give apples to elementary school children in the lunch line. And the fact that they cut those apples and put them in bags.
But they gave them free. So they could
have them.
An apple and a half.
But suddenly, if they cut them and put them in bags, it increased their consumption by over 70%. Just by making it easier. And that's...
So in other words, what you're saying is when the kids came through the lunch line and it was just grab an apple and eat it.
Yeah.
Only 0.13% or
so the actual putting it increased it by 70. So I think it was a massive increase just by making it easier, and that's essentially what this concept that Thaler really kind of pushed.
Well, I went through the thought process of that, and I thought about you'll go to meetings and whatnot, and all of a sudden, like you sent me a picture of this bowl, of apples. And he said, nobody wants the apples because nobody's bagged the apples. And you think about it and say, okay, eating an apple, and it tastes great and whatnot, but as you get down toward the core, now you're stuck with a core. You may not be near a trash can. There's other baggage that comes around with it.
That's right.
You got to have the right kind of trash can. You just can't put it into a trash can.
Yeah.
It's got to be in a special can. So you start thinking about if that apple was bagged, then it would make it much easier for me. Unzip the bag, take the pieces that are already sliced for me to eat, rezip the bag, put it in my pocket. So my wife, in our house in Florida, she did an experiment herself. She got some apples, beautiful apples, put them in a bowl, and put the slicer right next to it.
Yeah, you sent me a picture of it. It literally, it even wasn't even the knife. It was actually one of those single slicers. All you had to do was just put it on top of the apple, and it would have sliced the whole apple.
It puts it into 5 or 6 slices. Did I do that? No.
Yeah.
Because that meant I had to take the apple out, put the slicer down, and I had baggage. I got to wash the slicer now. She didn't bag them. So she was successful in her experiment that even putting the slicer next to it isn't going to get me to do it.
That's right.
And I love apples. So at any rate, that's the story.
Yeah. And
it's so interesting that people will do strange or different things than you would think of. One of the things he found out, too, was about 401ks, right?
Yeah, that's right. I think what it was is that instead of having people opt in to invest in 401, they had to opt out. So essentially, it was making it easy for people. And that's where really it comes back to in financial services. What can we do to our clients, even in for financial advice? How can we make things easier for them?
But I want to go back on that 401k again for a second. We glossed over it too quick.
Sure.
Think about this. Person comes into a company, and everyone deals with a 401k. And the company automatically puts you in a 401k.
Yep.
And you say, well, I don't want money taken out of I'm living hand to mouth right now.
Yeah.
Well, you can opt out, but you have to fill out papers.
That's right.
Only, I think, 30% of the people opt out that went in.
Yeah.
Then if you come into that company and they say, you have to fill papers out to opt into the 401k.
Yeah.
Only 30% of the people fill the papers out.
Yeah.
So people will do strange things, just like the Apple situation.
Yeah, that's right.
And there's probably interesting more things that he's talked about. But at any rate, what you have done when you keep saying to me, I say, what are you doing? You say, we're bagging apples.
Yeah.
You're taking very complex products, or I look at it as arithmetically complex products, and making it simple for the advisor to use in Mrs. Jones's account.
That's right.
Well, tell me about what Schwab might do. I mean, Schwab doesn't have to touch the options.
Yeah.
Now they'll do options. Why? What's the deal there?
Yeah. So, I mean, there's plenty of academic papers on the benefits of options. In fact, there was a study done by the OIC. I think they hired Cerulli to look at, how advisors actually use options.
OIC is Option Industry.
The Option Industry Council. That's right. And they looked at, what were some of the big reasons why actually advisors use options? The two big ones were one was generating income, and the second biggest was actually protection. Those are all benefits that options can provide. Yet the amount of advisors that actually trade options on a day-to-day basis is actually really small. The reason why it's difficult, right? Like we haven't made it easy for them to be able to access those benefits. So essentially, if you notice the overall marketplace, there are actually people out there that are packaging option strategies out there. And today, you could see those in let's say like structured notes or structured annuities, where banks are actually packaging them, which out there that gives you these types of strategies. So what we've done at CBOE Vest is that we have actually tried to package these option strategies so that way an advisor can just type in a ticker and get those benefits, right? And so as an example, so if I'm an advisor and I want to do, let's say, option strategies, there are an accepted amount of hurdles, just like the 401k that you talked about. I have to fill out a form, so on and so forth. Well, guess what? When you trade options, your clients have to what? Fill out a form, option paperwork, so on and so forth. They have to opt in to get those benefits, right? Now, if I'm able to, let's say, products out there that have cover calls already built in, then I can get those benefits just by like having it in a bag, right? Like that I don't have to sit there and start trading options every day, but I get those benefits. I don't have to, essentially in that same metaphor, I don't have to cut those apples, right? And that's essentially where the kind of metaphor kind of comes in. So when a lot of times when I'm, we're chatting, you're always asking me what I'm doing, that's what I'm doing. I'm bagging apples to try to make these things easier for advisors to access those benefits. And so what we've seen is that we start to and notice what we're focusing in on is the benefit, right? And this is where we have kind of coined the term target outcome investments, where we're actually targeting a specific protection, specific income, or specific growth level. And we can do that with options, as opposed to saying that, hey, you know what, I'm selling a call or I'm buying a put. We're now providing those benefits, let's say, in ETFs and mutual funds. So what are those benefits, right? Like I said, the number one benefit that advisors actually look for in options is income generation, which obviously this is a need that's actually growing more and more, especially
people my age.
Yeah,
absolutely.
exactly.
I'm a baby boomer.
Baby boomers are retired.
I'm on Social Security, and
Yeah.
and you're looking for that extra income.
That's right. And as that demand, right? As that demand goes up, it's getting higher and higher. But where do you find it? Right? So, you have high duration fixed income, high yield, high dividend paying stocks. Now, as this demand is increasing, everybody's chasing those because those are typically where you go. Now, think about it. Let's say I go to a high dividend payer. I need the income, and grandma needs to live off of that, and they go buy that high dividend paying stock. Guess what? Everybody else is chasing that too.
Yeah.
Right? And like you said, the law of supply and demand, if everybody else is demanding that, what happens to the price of that particular item? Goes up, right? So you're overpaying for just to get what? To get income. Now, what is a dividend, right? It's, a company essentially distributes its earnings because it's not going to grow, or it's giving up some of its growth. Yeah, exactly. Right. They're giving up that portion, distributing it instead of growing it per se, right? Mm-hmm. So in this case, now think about this. What if I chose, let's say, a growth stock, or let's say a quality stock as opposed to that may not pay such a high dividend, but then I help you get that income off of that. So for instance, I give you an example. Let's just add a hypothetical. Let's say I have 100 shares of Apple, right? And imagine if I wrote a call option on 7 of those shares. Well, guess what? The other 93 shares of Apple can grow, but I've given up the upside to those 7 shares. And by writing a cover call, I've generated what? Income, right? And I've given up growth to what? About 7% of that Apple position. Well, haven't I just created a kind of a synthetic dividend? I've picked let's say I've picked a particular stock that I like, right? That on a total return basis, not potentially not everybody, let's say, is chasing XYZ stock because of their income, but now I've actually been able to pick quality, but get what what do you really want? What does the investor want out of it, right? If they want income, I can write that cover call and get that income. So bringing it back, what have I done? I've made the consumption of that Apple, which in this case, the income, easy, right? Put it in that bag. And so that way you don't have to sit there and write cover calls. I know that, for instance, that in writing options, in your case, you do a lot of single day options, right?
Yeah, single day options because I'm a risk taker. It's not, I don't do this for the income part.
That's right.
But the single day options are something that's relatively new. And we always, when I came up in the option business, it was always a 90-day. You always thought out 90 days.
Yeah.
That was as far as your headlights could go out in the car, and that's as far as you wanted to go out as far as the covered right. And but now there are options that can come in the morning and they're out in the afternoon. So somebody asked me the other day, he said, what kind of things do you and your son do in the mornings before the market opens? I said, well, we sell naked straddles on 1 day, Standard and Poor's 500s. And he said, what do you mean? I said, well, picture you're on Coney Island. It's 9:30 in the morning, and you go to the ice cream man, and you get a big cone of ice cream.
That's right.
And I said, then you stand out there in the sun all day till 4 o'clock.
Yeah.
I said, how's that cone look? He says, well, it's all melted. I said, that's what we want.
That's right.
But it's high risk. It's not for anyone.
Well, what's great about and this is where there's actually a massive benefit in let's just say a daily option or a shorter term option, especially if you're selling it, right?
Right.
And in the option world, we call this theta decay. But what is it really? Let's talk about that. What's really neat is that when you sell an option, at expiration, if I'm selling, let's say, a cover call, right? I want that call to go to 0. Right, because I'm selling it, right? And what that movement, meaning that as it goes to 0, it's the fastest at the very end. So that's why when you choose that 1 day, it goes to 0 very, very quickly. Meaning that ice cream melts the fastest in that very end. So what's interesting is that they have daily options. Now they have weekly options. And the most popular is monthly options. So in fact, in that even in weeklies, that decay or that approach to 0 as you sell that cover call, you can actually generate what? Income. A lot more more income that way. So as an example, so for instance, one of our strategies takes the dividend aristocrats, the dividend growers of the S&P, and we start, and so we start writing cover calls on just part of the position, just like in my example, let's say a certain small percentage, like 7%, to hit an income target. Now, what we do in one of these strategies is we actually sell weekly options. Right? Weekly options. So that way we can have that ice cream melt really fast in that last 7 days, and you're able to generate more income, just like in your daily options. Because why? That last week is really where the price, the decay in that price starts to drop.
Off the cliff.
That's right. It's like what's interesting is that recently, the World Series has come to DC, and the World Series tickets, that were on sale. I think standing room tickets were over $1,000, right?
Wow.
Yeah, it's crazy. And so as an exercise, the folks on my team, we were monitoring the tickets just to kind of see how that, reduction in price, because just like options, tickets have a very similar feature that at game time, they're worthless, right?
Right.
Meaning just like an option at expiration, it's done. It's already over. So they all approach essentially zero.
So what was happening with the World Series tickets?
So the standing room were over $100, and then even as you come into the last day, they started to drop.
They were over $1,000, weren't they?
Yeah, they were $1,000. So even as we approach into that last hour, they started to drop to 900, 800, and then you actually at game time you get it to 400. By the way, the days leading up to it, there was no drop in price. In fact, they were going up. Right? Mm-hmm. But the thing is that as that last part of that time period starts to approach, that's where you get most of kind of the income that
that's
comes
where see the vision you give me. That's where that's where the cloud moves out from under the sun. Yeah. And you stand. That's when
right.
your ice cream starts to really melt.
That's right. And that's super exciting. So now let's bring it back to like bagging apples. Imagine if I was an advisor and I wanted to do this. So the dividend aristocrats, meaning the dividend growers of the S&P, there's about I believe about 50 plus, right? About 58, close to 60 positions. Now imagine if I wrote weekly options on each of them. So, 58-ish or on 60 positions, let's just say, just keep the math simple. Every week, 52 weeks out of the year, right? And let's say you had 100 clients. That would be over 250,000 trades you'd have to make. Think about that.
Do it.
Yeah. So what are you're trying to chase down that extra income, but you can't slice that apple.
That's right.
But guess what? If I'm able to give it to the advisor that they can consume that in a bag, guess what? Now they can get what? Get income from weekly options in a ticker, right? In fact, we're the only ones that are providing this solution. There's no other 40 Act fund that is able to provide that has single stock weekly options.
I love that concept because I was talking to an advisor the other day who is a close friend of mine. And I said, you have some of my money. Yeah. And I said, here's your marching orders. I would like to do a covered writing program in which we diversify as to industry and then diversify as to month. I don't want to get the top of the market or bottom of the market. Yeah. So I want a covered write where it's rolling off every single month. And he said, we can't do that. We've got to get all these paperwork in, and we've got to get compliance. And I said, then you would have to call me on every trade, even if I gave you discretion. No, I couldn't have discretion, not on option transit. So I'm thinking, you're not bagging my apples.
Yeah, exactly.
So let's talk about what Vest does.
Yeah.
And you put it all into a bag, and I don't have to go in front of compliance. They don't have to touch the apple; they just touch the bag.
That's right. And in fact, we move. In fact, the way we do it is we actually go backwards, right? Like we actually cut it in the slice in the exact size that the client wants to eat it in. Right? Some people like big slices, some people like little slices. So that's why what we do is we actually use a target income strategy. So if the dividend, if we target a specific income, so in our case, it would be 3.5 over the S&P div yield. So S&P div yield's about, hovers around 2. So you're talking about a 5.5%. That's our target. We're gonna sell just enough calls to hit that target. Right? So we're working backwards. If you want like your apple to be sliced 6 ways, 4 ways, we do that and we work backwards. We're like, hey, we'll cut it the way you want to cut it. That's how much income you want versus growth. We hit that target. And that's what's cool about target outcome investing is that we are able to see look at what is the specific objective, right? What is the specific protection amount, income amount for a specific time period, and then hit that particular target.
I love that. If I was back in production myself, I'd be using these like crazy. And it reminds me, when you say target, I think of target date funds.
Yeah.
Where a guy says, I'm retiring in 1940. Okay, let me just buy this fund and it's going to do everything for me in there. Here's your target yield.
That's right.
That makes more sense to me.
Yeah. And I think it's this target outcome investing from an income perspective, both in the ETF and mutual fund wrapper, really allows them to access these benefits, like let's say weekly options or monthly options, where the advisor doesn't have to trade it, but they get those benefits that can be so difficult to access or do on their own.
Well, it's like working with Legos, right?
That's right.
Yeah, that's one of the thoughts that you've had, and it comes to my thought. You're working with Legos, you're putting the customers, basically bolting things together for the customer that do something inside the bag.
That's right. Yeah, it's funny that you say the Lego thing, and where that comes from is that in my CFA class in which that I teach, the way I kind of teach options, I like to think about like the emotional experience that you get when you own a stock, right?
Right.
When a stock goes up, you feel what?
Feel great.
Yeah, feel good. When it goes
Smiley
down,
face.
Yeah, exactly.
Yeah, frowny face.
And when it goes down, you feel what? Terrible, right? If you don't feel that way, that we have drugs for that.
Yeah.
But otherwise, I can actually synthetically replicate that with options, right? How do I do that? Like, if I want to feel good when a stock goes up, I buy a call, right? I buy a call. Let's say the stock's at 100. I buy a call at 100. If the stock goes up, I'm happy. If I want to feel terrible when the stock goes down, well, put makes me feel good. How do I not feel good when it goes down? I'll sell a put, right? So if I go a long call, short put, I've replicated the emotional experience of owning a stock. So here's where the Lego concept is. I've broken the stock into two pieces, right? Essentially, I broke one Lego piece into two. Now I can move the strikes and construct the Lego piece back together in different ways. And this is where I start to get what? I can start building things such as like protection-based strategies. I can put the Legos back together to say, you know what? I want S&P, but I don't want to take the first 10% in loss. So fine. I won't sell the put at 100. I'll sell it at 90% down. Guess what? I don't have any loss between 100 and 90. And so this is what now, once again, going back to bagging the apples, if I take apart the Lego and I put it back together, put it in a bag, and I can hand it to the investor, now guess what? Now they have what? A hedged solution, protection, or essentially insurance on whatever position they have. I thought... and here's what's really neat about like target protection and kind of that insurance, and I think it's super interesting, is that concept of insurance, which I think we talked about a lot, is that I think the numbers that I have here are like I've seen on the internet, there's a 0.3% chance this year that your house will catch on fire. There's a 0.7% chance of death, right? And there's like a 2.1% chance of getting in a car accident. By the way, you have insurance for basically all three of those.
Right.
Yet there's a over 20% chance that you'll lose money in your portfolio. So think about that for a second. That you have insurance on the other three things, but yet there's a over 20% chance that your portfolio will fall, but you know, most of us don't have any type of insurance. Why? Because it's difficult, right?
Yeah, the apple's not bagged. I asked people, I said, if you just bought a brand new Mercedes, would you drive it home without insurance?
Yeah.
Oh, no way. I have to have, legally, we have to have insurance. I got to have insurance on the car. Second they do, they're gonna insure the car. So you could buy a put. If you're gonna buy a particular stock,
yeah, that's right.
Don't you want to insure it?
Yeah.
Somehow, in some way, shape, or form?
Well, how about I just buy a bicycle and a skateboard while I buy my Mercedes? So that way, if my Mercedes dies, my skateboard or my bicycle will go well, right? That's basically what? Diversification.
That's an idea. That's diversification, and that's insuring your transportation.
Yeah. The problem in 2008 is my bicycle and my skateboard both both broke, right?
That's right.
So yeah, I think having that ability for investors and advisors to be able to provide insurance or protection, I think is huge. I think it's especially in this environment today. And the thing is insurance. The great thing about puts and that type of insurance and creating, let's say, insurance based off of options, is that it's not based off of correlation, right? In 2008, as you start to have, large drops in the market, correlations start to approach one, right? Everything starts to fall. So that thing that you're basically looking for protection starts to leave you when you need it the most.
Right.
And that's why I think, having an ability to have that protection and being able to have it access it very easily, I think is going to be critical.
That's like saying you've got a portfolio, but you have a large position in utilities.
Sure.
And everything else is starting to go down, and then they finally come get the utilities.
That's right. So at Cboe Vest, we have products, mutual funds, and ETFs that essentially will also provide that built-in protection that'll be out there. So for instance, protecting that first 10% drop in, let's say, the S&P. And then instead of paying for that insurance, because, over the long term, just like in car insurance, right? I don't know how many people out there, I have yet to win on my car insurance trade.
Yeah,
hopefully I never win on that, right?
That's right.
But over the long term, buying insurance may not be the best. So that's why, just outright paying. So that's why what we do is we also sell, a cover call. So by limiting some of the up to a cap, you're able to pay for that insurance. And that's how essentially over the long term, you're not constantly paying that premium.
Well, human behavior, here's what I found about being on Wall Street for 45 years.
Yeah,
You wouldn't drive your Mercedes off the lot without insurance on it.
that's right.
But when it comes to stock, you could maybe tell a customer, we've done well in the stock. Let's buy a put, and we're going to insure the stock from this position down. So I bought a stock at 50. It's now 100. I buy a 100 put, and now the customer's concept is different.
Yeah.
I want that stock to collapse. I paid for that insurance.
Yeah.
I want to use that insurance, and if it expires worthless, then it was worthless doing it.
Yeah.
So I asked him, I said, if you didn't have a total wreck on your car on the way home, was that
Exactly.
Did that bother you that you didn't get to use your insurance on the way home?
Yeah.
So people, just like Thayer had determined, people do strange different things.
Yeah.
This is the way people think
That's
when
right.
they buy a put. So it'd be much easier to have that put wrapped up
Yeah.
into something, doing the job for them that they really need, rather than looking at it and saying, wow, this didn't perform.
I love that. I love that, Tom. Because that you're talking about another benefit that comes with putting into let's say a fund wrapper or bagging it.
Right.
Is that it creates a discipline, right? That hedge automatically rolls. So, for instance, we have several different types of strategy. We have ones that potentially go let's say point to point and then reset, or we create just like a bond ladder.
Wait. Point to point and reset.
Meaning after 1 year, after 1 year, the hedge will put back on, because like you said, a particular investor would be like, hey, I bought that put for let's say 1 year. I never used it. Why would I want to buy it again? Right.
Exactly.
So what happens is now the bag suddenly just does it inside, right? The product actually does it itself.
Cool.
Or another way, a lot of times what ends up happening is that, let's say I don't want to, if these types of strategies, I can just have them roll like a bond ladder, right? A lot of times people may not buy just, let's say, one bond. They buy an entire ladder, right? In some cases, that if I'm buying a bond fund, I'm buying a laddered bond fund, right? And so same thing with hedging. So we could ladder those hedges and be able to have that laddered hedge very simply and access through, let's say, a ticker is something that just like that, bagging that kind of the hedge execution is also there. That way, like you said, it instills that discipline to persistently keep that insurance on, right? Because I guarantee you, I don't know, a lot of us, if we were faced with a decision, every month about, do we want to buy our car insurance? Do we want to buy it? And we have to keep renewing every month. I'm not sure all of us would keep pressing that button every time that we had to pay that money, right?
Certainly wouldn't. Because there's so much information around, this market is going to be bullish, therefore I don't think I need that insurance.
Yeah.
It looks to me like the traffic is low on the way home from the dealership. So I don't think I'll get the insurance.
That's right.
Today.
I'm not driving that much this month. I'm going to cancel it, right?
Exactly.
That's right.
That's the way people think when it comes to their markets. That's why what you do is so essential to overcome the way people think.
Yeah.
And that's what Thayer got his
Make it easy.
Make it easy.
Make it easy.
Make it easy. Think about DocuSign.
Yeah.
You send me a bunch of papers and you say, sign these papers.
Yeah.
They're going in the drawer.
That's right.
I'm not going to do that.
Yeah.
Send me DocuSign with an arrow pointing right there.
Yeah.
I'll do it right away and send it back.
That's right.
DocuSign bags your apples.
Yeah.
The regular person who sends you all this paperwork all the time isn't.
Yeah. I think the other thing was that not only DocuSign makes it easy, it's also very if you ever used it, it's very easy to, you're like, hey, do you want to sign this? And it takes you exactly where you need to go with your signature, right? It makes it even the execution itself makes it quite easy.
You know what we're doing? We're advertising for DocuSign.
Yeah. which is fine. The concept is interesting.
They didn't sign on to this program.
Yeah, exactly.
Because we don't do any advertising on the program.
Yeah, but what's great is that if you make it easy, then people can access those benefits, right?
Absolutely.
Yeah.
Absolutely. I did this with you once.
Yeah.
Remember we did an Apple?
That's right.
We did an Apple computer, and I did some real estate.
Yeah, that's right.
I think the Apple computer
We converted to income, right? I believe
we
paid
took
it.
the Apple computer and converted it to income.
I think it was almost double-digit yield, right?
Yeah, I did. I had a double-digit yield. What did we do with the real estate? I can't remember what.
I think that was we provided some protection, and we were I believe it was on a real estate ETF. We provided some protection. I think it was like maybe a 10% buffer, and then it was actually I think it was uncapped. You got all the upside, with some protection, essentially paid for by the dividend.
The thing people need to understand is the Option Clearing Corporation once came out with a saying, options give you options.
Mm-hmm.
And when you look inside of these, we might not own the S&P 500.
Yeah.
We own it synthetically.
That's right.
And people say, well, how do you create synthetic stock? What is that? Well, I want to create with puts and calls the exact risk parameters as if I own the stock. Okay, so I could buy IBM at 100, or I could sell a put at 100, take the proceeds and buy the call, and then separate the two and say, what happens if the stock goes to zero?
Yeah.
So when I sold the put, it's going to go against me, but I took in premium.
That's right.
I took in premium. So I'm only going to lose as much as that premium. And the call side, the same thing. I took in the premium. So the cost is going to be relatively small in that position.
Yeah.
But you created it synthetically.
That's right. That's right. And you have the same experience as the stock goes up. You feel good as it goes
Stock
down.
goes down. Exactly. The put will go against you 100 points if it goes to zero.
Yeah.
And if the stock goes up 100 points from there, you do well.
Yeah.
And you have the exact same position as if you were in the stock.
And what's neat is you can do this on most underlyings out there. Like I could take PDP. I could then let's say start trading options on that, create some level of protection on any SPY, any like even single stocks, anything with listed options on there. I could start like I said before, like create these Legos and do exactly once you understand that synthetic concept that you're talking about, where if I'm long that call and short that put.
And it's basic fourth grade arithmetic.
Yeah.
None of this that seems esoteric gets past fourth grade arithmetic.
Yeah.
For sure.
Yeah, that's right.
But it's a matter of compartmentalizing things in your mind. The way I learned options, way before you were born.
Yeah.
I think you weren't born before 1974, were you? Or after 74?
No.
Before 74 was when I started getting involved with options.
Yeah.
There was nothing written on options. So what did I do? I took a legal pad and a pencil, and I went home weekends, and I would put strategies on.
This was at We First, right?
No, this was Merrill Lynch.
Okay, got it.
It's where I first started Merrill Lynch. I ran the option department at We First Securities. By this time, this is my first year.
Yeah.
And the reason I wanted to learn about options is I was prospecting people who had just been wiped out in the 1970, 73, 74 bear market.
Yeah.
Nobody told me there was a bear market. I'm coming in from Merrill Lynch riding a white horse. I was just finished being taught how to sell.
Yeah.
I had no idea that I'm selling to people who have been wiped out totally.
Yeah.
And after the first year, I said, this is a tough job. I mean, prospecting. I said, if I'm going to be successful, I better become an expert at something. And options were pretty new, a couple years old. And I said, that's going to be my direction. But the only way to learn the options, and the fun way to do it, is to, like Legos, assemble and disassemble. And when you do a particular strategy, you got a couple of pieces there. And you can say the stock went here, went up 10 points, the stock went down 10 points. I'm just going to take these pieces off. Let's look at each one separately.
Yeah.
And in fourth grade arithmetic, I'll end up with a plus or a minus. And then what I'll do is reassemble the Legos. And I have X numbers of pluses, X numbers of minuses.
Yeah.
And you either won the trade or you didn't win it.
Yeah.
And that's the way you do it. And then the mind begins to compartmentalize it. And it's fun. Get a glass of wine on the weekend.
That's right.
And start doing these types of things. And you really learn options that way, rather than trying to get some kind of a difficult book and learning all the Greeks and things like that.
Yeah.
Just do the simple arithmetic.
You don't have to make it complex.
No,
right?
no. Arithmetic.
Yeah. No, it's funny. For my introduction in options was actually not wasn't as straightforward. Like I actually didn't know I was getting into options. I actually started. One of my first jobs was on a mortgage-backed securities trading desk. And then the thing is that most people don't realize that mortgages have options.
Yeah,
right?
People don't realize that.
Because what happens when interest rates fall? What do homeowners do?
They
refinance. Guess what? That's an interest rate option, right? It's basically
your ability to change your position.
It's essentially an option on interest rates, right? Because the homeowner has an ability to say like, hey, I want out. That's an option on interest rates, right? It's a swaption, an option to swap out on interest rates. And everybody that owns a mortgage has that option.
So
they're long.
They don't realize it.
Yeah, they own that. And so as working on a mortgage-backed securities trading desk, you have to know optionality. You have to study, how options work. And that was actually my introduction that I was thinking I was, getting into fixed income. But in reality, it was actually, being schooled in how options work. So there's a lot of stuff that's out there that it kind of builds upon that's out there.
And then, from there, I'm not going to let you off the hook this quick.
Yeah.
From there, where did your option training continue?
So, I started working in convertible bonds as well as options later on. And then had a brief stint at an ETF shop. And then after that, we started SIBO Vest, which, being a partner with the largest option exchange, we started getting into structuring these option strategies. So these types of strategies, and like I said before, have existed, right? In structured notes and structured annuities. We're providing a different type of, allowing some investors that, may not be in those types of securities to be able to access these benefits, right? Through, let's say, ETFs, mutual funds, UITs, different types of wrappers that they can now get those benefits. And that's kind of where it kind of exceeded, going from mortgages to convertible bonds to options to now packaging them.
Right.
So that's what's super exciting, is to be able to put those together and get those out.
Now, your partner is an engineer.
That's right.
Tell me about
So Karan Sood is my partner. We met at our previous shop. He's actually an engineer from IIT, which is the India Institute of Technology. It's essentially
the India Institute of Technology is like the best in the world.
Yeah. And this is what's so great, is because, like, if you're building Legos and you're putting things together, the best is engineers, right? They take things apart, put things together.
That's right.
He's that's his background. Went to the London School of Economics. And had a stint at Barclays working on the structuring desk and option desk there, putting these types of strategies together for the banks. And so we met at an ETF shop. So kind of a combination of structuring background, option background, and kind of fund background is how you get to, hey, all of these benefits, put them together, and able to deliver it to financial advisors.
Now, when I met you two guys out in California, what year was that? You're going to remember. You're going to remember better than I will.
2012, maybe.
2012.
Yeah, 2012.
And I met you two guys, and I'm an option guy from way back. And when I met you two guys, and I'm starting to talk options with you, I said, "Oh my God, this is a whole new level. This is like there was microwaves coming out of you guys' head right there. I'm standing in between it." And I said, I got to get to know these guys. And from that day forward, I have, and you've done a phenomenal job in engineering these things.
Yeah. We continue to do that. I think we have, we have our product pipeline is, we got a lot of stuff coming out. I think we're pretty excited about it. Yeah.
What are a couple of, one more time before we stop here, what are a couple of the products you have?
So we have, like I said before, we have income-based target income products.
Right.
One of them is we have mutual funds and ETFs, and then we have a couple of ETFs that we will be launching in partnership with our affiliate First Trust. The strategies are currently, our target income strategies, where we're targeting a specific income, and then writing cover calls to hit that target. Both of them point to the dividend aristocrats, which is dividend growers.
I like that group of stocks.
And these are the dividend growers, and these are all index based. So these are all rules based process. Because not only do you want to make sure that it's easy for advisors and investors to consume, but make sure that it's easy for them to understand. right?
Exactly.
So that's critical. So it's, you have your dividend growers. We're selling selling cover calls on just some of those positions to kind of generate that income. The second one is that we do buffer strategies. And what we do is we protect, let's say, the first 10% drop in the S&P, and you get the price appreciation, let's say up to a cap to let's say the S&P ETF, right? SPY. So those types of strategies, we have different levels of buffers out there, and so on and so forth. And you probably, there's some other companies that have come out with some of those products, which, ours will be slightly different. There'll be, positives and negatives there on those slight differences.
It makes me think about this course that I taught at Diamond Billiards, which my son owns. It's, I hate to say the word pool hall, billiards establishment.
Sure.
It's got a restaurant, it's got dining, it's got everything. But I taught a course there for 2 years.
Yeah.
And it just happened that a lady came to me and said, Tom, could you help me with my 401k? Well, I'm always willing to help anybody. I said, sure, I'm willing to help you with the 401k. Next thing I know, she comes back. She says, I've got 6 other women. Could you help all of us? I said, sure, I'd be happy to do it. Then my son says, well, why don't we just make it available to the people who come to Diamond? He did. Next thing I know, I had 37 people in my class. One of the guys was an engineer. Now, what I couldn't understand is we went through option strategies. He couldn't get it. He wasn't getting the option strategies. He was thinking too hard.
Yeah.
Then all of a sudden, one day it clicked. You couldn't stop him. That was like the flood door open. The finger came out of the dam.
Yeah.
His head just filled up and said, I get it.
Yeah.
I get it. And then started doing some great trades himself. I mean, and then taught his children to do it. But it's there. It's there for the taking.
Yeah. No, absolutely.
Jeff, before I let you go, I want advisors to know where they can come get more information on this. We can sit here all day and talk about it.
Sure.
What web address do they go to get?
Yeah, so they can actually come to our website at cboevest.com.
cboevest.com.
Yeah, so
okay.
VEST, so cboevest.com. Yeah, exactly what you're wearing there. There you go. And you can, it can kind of just map you to wherever you need to go and find those, what you're looking for as far as target outcome investments.
Do they have the ability to call you guys and talk to you?
Yeah, absolutely.
So an advisor is working with a customer, he can call you direct
That's right.
and discuss it?
That's right.
I love it. I love it. This is the key. Absolutely. Well, thanks for watching. We'll wrap it up this week. I guess we could be a little long. I could go on forever with options. We'll talk to you next week.